When you go to a store and buy something, the transaction is, it's incredibly straightforward. Like, you hand over your money and they hand you the item.
Right, yeah. It's a clean, visible exchange.
Exactly. The rules of commerce are totally transparent. You know exactly what you're giving up, and you know what you're getting in return.
But then you step into the world of home insurance.
Yeah. And suddenly you're walking through a hall of mirrors. I mean, you think you bought this protective shield for your home, but when a disaster actually hits, like a fire or a hurricane or a burst pipe, you find out you actually purchased a multi-billion-dollar puzzle.
And the most critical pieces of that puzzle are buried in totally cryptic policy language.
Right.
Missing those pieces can be financially devastating. I mean, people often find themselves completely unable to afford the repairs that their policy was supposed to cover.
Which is exactly why we are doing this today. Welcome to today's Steep Dive.
Yeah.
Our mission is to pull back the curtain on the hidden mechanics of home and property insurance payouts.
We really want to decode that language so you don't leave thousands of dollars on the table after a disaster.
Yeah, and to do that, we've been digging through a massive stack of industry research. Like, we are not just looking at one perspective here.
No, we're looking at 50 state legal surveys from law firms, class action litigation reports, policyholder advocacy guides.
Even insider blogs from public adjusters who fight these battles every single day.
Yeah, the people right on the front lines.
And all of those sources point to this massive, ongoing, nationwide legal war over what is, honestly, a surprisingly philosophical question.
It really is. The question is basically, can human labor lose its value over time?
Right. Can human sweat depreciate? Which sounds like something you'd argue about in, like, a college philosophy seminar, but the answer literally dictates exactly how much money you receive to rebuild your life.
It completely determines the size of the check in your hand. But, to understand why human labor is suddenly on trial, we really have to dismantle a very pervasive myth about how an insurance claim actually works.
Oh, I know the myth you're talking about because I completely believed it.
Most people do.
You pay your premiums for 10 years, a tree falls on your house, the insurance company sends someone out, they crunch some numbers on a clipboard, and they hand you a single check to cover the cost of rebuilding.
Yeah, that is the illusion of the payout. For almost any significant claim, the single check system just doesn't exist.
It's not a thing.
Not at all. The industry operates on a two-check system, and the entire roadmap for how those two checks are calculated is sitting in a document you probably haven't looked at since the day you closed on your house.
You mean the declarations page?
Exactly, the debt page.
I always see that term in the paperwork. But, I mean, it just looks like a spreadsheet of alphabet soup and random numbers. Like, what am I actually looking for there?
So think of it as the blueprint of your financial protection. The two biggest categories you'll see are Coverage A and Coverage C.
Okay.
Coverage A is your dwelling limit. That is literally the physical structure of your home, like the walls, the roof, the foundation.
Wait, so is that based on what I bought the house for? Or what it's worth on the market?
No, not at all, and that's a really common trap.
Yeah.
It's actually based on what it would cost to rebuild it today from the ground up.
Oh, wow. Okay.
Yeah. To put that in perspective, current rebuilding costs typically run between $180 to $350 per square foot.
Oh.
It entirely depends on your zip code and the local cost of lumber and materials.
Makes sense. And what about coverage C?
Coverage C is personal property, your furniture, your clothes, your electronics. That is usually set automatically at about 75% of whatever your coverage A limit is.
So if my house is insured for $400,000, my stuff is insured for up to $300,000.
Roughly, yeah. Those are the maximum limit.
Okay, but let's say my house doesn't burn to the ground. Let's say it's just, I don't know, a localized fire in the living room. How does the insurer decide what the damaged stuff in that specific room is worth on a random Tuesday?
That calculation comes down to two vital concepts. And you will definitely see these acronyms on that declarations page. RCV and ACV.
All right, hit me.
Replacement cost value, RCV, is exactly what it sounds like. It's what it costs to walk into a store today and buy a brand new version of whatever was destroyed.
Okay, replacement cost value is the retail price today. What is the other one? ACV.
Actual cash value. This is what the item was actually worth the second before it was destroyed. Meaning the brand new replacement cost minus depreciation for age, wear, and tear.
Okay, I want to make this tangible because this is where that single check myth totally falls apart. One of the legal surveys we looked at uses a really clear example of a sofa.
Yeah, that's a great example.
So let's say I have the good coverage replacement cost value coverage. My sofa gets ruined in a fire.
Mm.
I go online, and to buy that exact same sofa brand new today would cost $1,500. I should just get a check for $1,500, right?
You won't. Because your ruined sofa wasn't brand new, it was 3 years old.
Right, but I have replacement cost coverage.
True. But the insurance company applies a depreciation rate to account for those 3 years of you sitting on it. Let's say they decide it has depreciated by 30%.
Okay, so 30% off the 1,500?
Exactly. They take that $1,500 replacement cost, subtract 30%, which is $450, and they hand you an initial check for $1,050.
And that's check number one.
That is your ACV check. Check number one.
But again, I paid for replacement cost coverage. That means I am legally entitled to the full 1,500. Where is the rest of my money?
It's sitting in a category called recoverable depreciation. The insurance company essentially holds it hostage.
Wait, really? They just keep it?
They keep that $450 until you take the $1,050 they gave you, dip into your own savings to cover the difference, go buy the new sofa, and then submit the receipt proving you bought it.
That is wild.
Only after you prove the purchase do they release check number 2.
And reading through the policyholder guides, there's a ticking clock on this, right?
Yeah.
You usually only have somewhere between 180 days to maybe 2 years to complete the replacement and file all the paperwork.
Yes. Very strict deadlines. And if you miss that deadline, they just keep the holdback money forever.
Unbelievable. What is their excuse for doing it this way?
The industry's stated justification for this is fraud prevention.
Fraud prevention. How?
Well, the argument is that if they handed you the full $1,500 up front, you might just buy a cheap $200 futon from a thrift store and pocket the difference. Or use the money to go on a vacation.
Ah, I see.
The two-check system forces you to actually spend the money on restoring the property.
Okay. I mean, I understand the theory behind fraud prevention, but looking at the sheer mechanics of this, doesn't it function exactly like a mail-in rebate?
A mail-in rebate. Explain what you mean.
Well, companies offer mail-in rebates because the math is on their side, right? They know a massive percentage of consumers will simply forget to mail the form, or they'll lose the receipt or miss the postmark deadline.
Oh, for sure. It's calculated.
It is a system of built-in friction. Now apply that to a family whose house just suffered a major fire. They are displaced, living in a cramped hotel, trying to keep their jobs going, getting their kids to school in a different zip code.
They're totally exhausted.
Right. And the insurance company tells them, sure, we have the rest of your money, but first you have to float thousands of dollars out of pocket, manage all these contractors, track every single receipt, fill out our specific forms, and hit our strict deadlines.
Yeah, it's a lot.
It feels like friction intentionally designed to make exhausted disaster victims just give up and leave the money on the table.
And policyholder advocates point out that exact dynamic. It places an immense administrative and financial burden on people when their lives are entirely upended.
I can't even imagine.
I mean, if you don't have the personal cash flow to bridge the gap between that first ACV check and the actual cost of a new item or a new roof, you can't start the work. And if you can't start the work, you can never claim the second check.
That is so messed up. And that structural friction brings us to something even more aggressive. If the entire two-check system relies on this concept of depreciation to shrink the first check, we have to look at how that depreciation is actually calculated.
This is where it gets really interesting.
Because we can all logically agree that physical things lose value. A 3-year-old sofa has wear and tear. A 15-year-old roof has brittle shingles.
Right, physical deterioration is a universal fact. But over the last 2 decades, insurers have drastically altered the math.
How so?
They aren't just depreciating the physical materials anymore. They are depreciating the cost of the human labor required to install those materials.
Depreciating labor. Just
Yeah.
depreciating the physical act of a human being working.
Yep. Let's look at the financial impact of this, using another example from the legal surveys. Let's say a pipe bursts and floods your kitchen, ruining the laminate flooring.
Okay, terrible Tuesday.
Right. And the floor is halfway through its expected lifespan. Your contractor gives you an estimate. Replacing it will cost exactly $10,000. $5,000 for the physical laminate planks, and $5,000 for the contractor's labor to rip up the old floor and install the new one.
Okay, the floor is halfway through its life, so that's 50% depreciation.
Exactly. Now, if the insurer only depreciates the physical materials, they take 50% off the $5,000 in materials. That's a $2,500 deduction.
Okay, leaving the labor untouched.
Yes, they leave the $5,000 in labor untouched because labor isn't a physical object. So your first check, your ACV check, is $7,500.
Leaving me to float $2,500 out of pocket. Annoying, but maybe doable.
But if the insurer uses software that depreciates the materials and the labor, they take 50% off the entire $10,000 bill.
Well, off the total.
Yes. Your first check drops from $7,500 to just $5,000.
Wow. That is a massive difference. And when you scale that up to something like a roof, the sources note that roofing costs are typically 40% materials and 60% labor.
Exactly. It's mostly labor.
If an insurer applies age depreciation to the labor on a $30,000 roofing job, that first check is going to be so small the homeowner won't even be able to afford the deposit for the roofer.
It creates an almost insurmountable out-of-pocket gap for the average person.
But the math aside, the fundamental logic here is what drives me crazy. How can sweat depreciate?
That's a great question.
Like, if
Yeah.
I take my 10-year-old car to a mechanic, his hourly rate doesn't drop to half price just because my car has 100,000 miles on it. He still has to turn the wrench just as hard. He still spends the same amount of time.
Yeah, the effort is identical.
Labor is an intangible service. It doesn't rust, it doesn't rot, it doesn't wear out.
And that mechanic analogy is the exact argument currently tearing through the United States court system. Because standard insurance policies for decades simply use the word actual cash value or depreciation without clearly defining whether it included human labor.
So now everyone is fighting over it.
Yes, we are now seeing a massive wave of class action lawsuits. For example, in the First Circuit in Massachusetts, there's a major case called the Glasner case.
Oh, I saw that one in the litigation reports.
Homeowners there successfully certified a class action specifically because insurers were using standardized software to just uniformly apply labor depreciation across the board.
Wow. A literal 50-state legal battlefield. And what is truly wild about this stack of legal surveys is that the outcome of this multi-billion-dollar question depends entirely on your zip code.
It really does. Let's look at the states where the courts agree with your mechanic analogy.
The states that say no to labor depreciation.
Right. In Illinois, you have a landmark case called Sproul v. State Farm. In Tennessee, there's Lammert v. Auto Owners.
What did they decide?
The Supreme Courts in these states looked at the issue and ruled that labor is strictly an intangible component. It cannot logically deteriorate. They even referenced Black's Law Dictionary, which defines depreciation as physical wear and tear.
That seems like common sense.
Plus, they relied on a fundamental principle of contract law. If the language in a policy is ambiguous, the interpretation must favor the policyholder who didn't write the contract.
So in Illinois and Tennessee, labor holds its value. The courts protected the homeowner, but clearly not every state went that route.
No, definitely not.
How do the courts on the other side justify depreciating human sweat?
The counter-argument is actually quite fascinating, and it's built on something called the unit theory. Courts in South Carolina and Nebraska adopted this. Yeah. They argue that a homeowner doesn't buy a pile of loose shingles, a bucket of nails, and a guy swinging a hammer. They buy a finished, unified product, a roof.
A single unit. Okay.
Think about a smartphone. When a phone gets old and loses value, you don't say, well, the lithium in the battery depreciated, but the labor of the factory worker who assembled it didn't.
Oh, I see where they're going with this.
Right. The entire phone depreciates as a single product. These courts ruled that a home is a unified structure. The labor is inextricably embedded into the finished product. Therefore, it is completely impractical to separate the value of the physical wood from the value of the labor that installed it 10 years ago.
So the whole unit depreciates together.
Exactly.
Right.
And the insurance lobby felt so strongly about the unit theory that in Arkansas, they successfully pushed the state legislature to pass a specific statute.
A law specifically for this.
Yes. It legally permits insurers to depreciate labor as long as they use specific disclosure forms.
The geography of this is mind-bending. If you live in Illinois, labor is an intangible, timeless service. You cross the border, the laws of physics change, and human labor decays just like a piece of wet drywall.
And if you want true chaos, look at the states that haven't firmly decided. In Texas, 2 different federal courts recently analyzed the exact same policy language and arrived at totally opposite conclusions.
You're kidding.
Nope. And in Minnesota, the state Supreme Court ruled that there is no strict rule at all. It is up to a jury to decide on a case-by-case basis if depreciating labor logically tends to establish the true value of the property.
So if your kitchen floods in Minnesota, you just have to roll the dice and see what 12 random people think about the philosophy of a plumber's sweat.
It creates immense unpredictability. Now, you might be listening to this and thinking, okay, the initial check might be shockingly low if I live in a state that depreciates labor. But as long as I have replacement cost coverage, I just need to find a way to finance the repairs temporarily, and I'll eventually get all that money back in the second check.
Right. Like it's a cash flow nightmare, but theoretically you are eventually made whole.
In theory, yeah. But this brings us to what the insider adjusters refer to as the final hurdles of a claim. Let's call them the final bosses.
Okay. I don't like the sound of that.
The first final boss is non-recoverable depreciation.
That implies there's money you never get back.
Exactly. If you look at your declarations page and discover you have an ACV-only policy, meaning you do not have replacement cost value coverage, then any depreciation deducted from your claim is permanent.
Oh, wow.
It is non-recoverable. You will never get that second check no matter how many receipts you submit.
So if a storm destroys your 20-year-old roof,
They will hand you a check for the actual cash value of 20-year-old shingles, which might be practically nothing. You have to pay the tens of thousands of dollars for a new roof entirely out of your own pocket.
this highlights how devastating that labor depreciation argument really is. Like, if you have an ACV-only policy in a state that allows labor depreciation, you are getting hit with a permanent double whammy.
A massive double whammy, yes.
They deduct the physical value of the old materials forever, and they deduct the value of the labor forever. You're left with pennies.
Which makes checking your policy type the single most vital action you can take. But even if you confirm you have the good coverage, the replacement cost coverage, there's another final boss insurer sometimes used to suppress that first check.
Another one.
Yeah, it's an acronym. GCOP. General Contractor Overhead and Profit.
GCOP, what is that?
So when you suffer major damage, you don't usually hire the plumber, the electrician, and the drywaller separately. You hire a general contractor to coordinate the entire project.
Makes sense.
That general contractor typically charges about 10% for their overhead, like keeping their trucks running, paying their office staff, and another 10% for their own profit.
Okay, so that 20% markup is GCOP. That's just the cost of doing business.
It is. But when calculating your initial ACV check, some insurers will take the total replacement cost, deduct the 30% for physical depreciation, and then exclude or withhold another 20% for GCOP.
Wait, why would they do that?
They argue that because you haven't actually hired a general contractor yet, they shouldn't have to pay for the overhead and profit in that first check.
Wait, I want to use an analogy here. That is like going to a restaurant, ordering a meal, and when the bill comes, telling the waiter, I know the steak is $50 on the menu, but I'm only going to pay you $20 for the raw cost of the beef and the vegetables.
Yeah, that's exactly what it's like.
I'm not paying for the chef's time, the electricity in the kitchen, or the restaurant's profit margin.
And that is precisely how the courts have handled it when policyholders push back. In a major Pennsylvania case called Gilderman, the court flat out rejected the insurer's practice of withholding GCOP.
Oh, good. What did the judge say?
The judge pointed out that the actual cash value of anything inherently includes the overhead and profit it took to bring it to market.
Right.
You wouldn't deduct a dealership's profit margin when determining the value of a totaled car. The profit is just baked into the value.
It feels like the average homeowner is completely outgunned here. You are standing in your flooded living room trying to read a 50-page contract, and the institution writing the checks has 100 different ways to minimize what they owe you based on obscure acronyms and 50-state legal loopholes.
Which is exactly why the blogs from public adjusters emphasize getting professional representation.
Like hiring your own adjuster.
Yes. An insurance adjuster works for the insurance company. Their primary directive is to protect the insurer's bottom line by applying these rules as strictly as possible. A public adjuster, on the other hand, is a licensed professional you hire to represent you.
So they act as your advocate.
They act as your translator and your shield. They know the current case law in your specific zip code. They know if labor can legally be depreciated in your state.
Right.
They know how to argue the Gilderman precedent if an insurer tries to withhold GCOP. They balance the scales so you aren't fighting a multi-billion-dollar algorithm by yourself.
We have covered incredible ground today. We started with the dense text of the declarations page, broke down the reality of the two-check system, and explored how a single philosophical argument over human sweat is creating chaos in Supreme Courts across the country.
It really underscores how a single word in a contract can hold billions of dollars in consequence.
Absolutely. So, here is your actionable takeaway from this deep dive. Sometime today, open your filing cabinet or log into your insurance portal and pull up your policy. Look at that declarations page. Do you have ACV or RCV coverage?
Seriously, check that today.
And do a quick web search. How does your specific state handle labor depreciation? Knowing the rules of the game before the board is flipped over is the only way to protect yourself.
Taking that step is crucial, especially when we look at where this is all heading.
What do you mean?
Well, throughout this research, we saw how insurers use standardized estimating software to automatically apply these deductions across thousands of claims with a single keystroke. But think about the next leap in technology.
You mean beyond just standardized software?
I'm talking about artificial intelligence combined with remote imagery. We are rapidly approaching a reality where, after a hurricane, a drone flies over your neighborhood, snaps high-resolution photos of your missing roof, and feeds those images into an AI model.
Oh, wow.
Before a human adjuster even sets foot on your property, that AI will instantly assess the damage, automatically categorize the materials, and calculate the depreciation.
It will just generate the payout entirely on its own.
Exactly. And the profound question is, how will those algorithms be trained?
That's terrifying.
Right. If an AI is trained by an insurer in a state where the law is ambiguous, will it be quietly coded to automatically maximize labor depreciation and withhold GCOP by default?
You wouldn't even know.
Will the nuances of case law and fairness be buried so deep inside a black box algorithm that you won't even know you're being underpaid? We are moving from fighting human adjusters over the philosophy of sweat to fighting faceless machines programmed to protect the house.
That completely reframes the challenge. You think you are buying a simple safety net, but you're actually entering a system where the complexity is automated and the rules can change without a human being ever looking at your home. You're left navigating a hall of mirrors, and it seems like the reflections are only going to get more distorted. Thanks for joining us on this deep dive.